Welcome to Proficient Group and welcome to a new edition of our educational web series. Today is 14th of April 2018 and this week our topic is different as whatever we had talked in our earlier editions. This week we are going to talk about moving averages. Although many people uses moving average in different ways, and in fact, moving average is an age-old technique of technical analysis. Today, we are going to see different aspects of using this moving averages, right? Before I actually enter into today's topic, let me introduce you with the basic fundamental parts of moving averages, right? Now, in the lower part, in the lower pane of my chart, you can see the diagram of Nifty. It is a candlestick daily chart of Nifty, and you can see two moving averages here. One is the red one, that it is the 200-day moving average, simple, and the blue one is the 50-day moving average, simple, right? Just for sake of continuity, I may say that what is moving average? Moving average is nothing but when we are calculating a certain days moving average, what was the average price of that many days historically, right? So if I am saying it is a 50-day moving average, it means it is the average closing price of the past 50 days, and it is the average closing price of past 200 days when I am calculating 200-day moving average, right? And the beauty is that when a new price is added to the right of the chart, when a new day is coming, an old day is automatically eliminated and we get a new price of the moving average. Moving averages are traditionally used for various purposes, mainly to detect the trend. Say, for example, if prices are above a moving average, it is roughly said to be in an uptrend. If prices are below a moving average, it is roughly said to be in a downtrend. But there are lots of catches there because sometimes prices keep going up and down across a moving averages, right? And in those that kind of use also requires to be mentioned what is the window of the moving average, what is the time frame of the moving average, because longer time frame gives you a robust and more primary longer term trend sets, right? And shorter term moving averages gives you more zigzag or short term version of the trend. Longer term moving averages are actually better to give you the general direction of the trend, but one can use the short-term moving averages for actually making the entry or exit decisions. That is, these things are pretty conventional, right? There is nothing new in these conceptions. And also there is other techniques like dual moving averages, like triple moving averages. And in this way of analysis, suppose for dual moving averages, when a short-term moving averages remains above a longer-term moving average, it is said to be a buy signal, or vice versa. When a short-term moving averages goes below the longer-term moving averages, that means prices are more likely to come down, and there is a sell signal, and vice versa. Okay. So, and there are various other ways of calculating moving averages, like we can use simple moving averages, which is the normal way of calculation that we have been doing for in general. That is, we just add the past several days closing price and dividing it by that number of days. But we can also use exponential kind of moving averages or triangular or weighted moving averages, but these are a bit complicated. The actual difference is only the weighted system, right? In exponential kind of calculation of moving average, the weightage, more weightage is given to the latest portion, to the right part of the chart. The latest price is given more weightage, whereas in triangular moving average, weightage is given more to the middle of the data, right? And in weightage moving average, I can vary my weightage. Where should I give the most weightage, right? But all these things actually do not make much of difference, as I'm telling you. And simple moving average will solve our purpose quite well. So today we are going to confine our discussion to the realm of simple moving averages, and we will explore various other characteristics, and we will try to find out some innovative ways of trading with moving averages, right? Now, today, what I intend to do is we will give you, or rather I will show you various different ways of using moving averages, where from you will get some, I believe you will get some good ideas, some good food of thought to proceed it further, right? How we can use moving averages in several other ways, right? Apart from whatever we have told right now, right? And these are not mentioned in any books, and the books are already discussing, the books are only discussing whatever I have told you, the dual moving average, the crossover, all these things, right? So let's start today's session with some new kinds of uses of moving average. Here I am going to give you today actually 4 different types of uses, new uses of moving averages, and I think you will like that, you will enjoy it, and it will give you more food of thought. First one is pretty simple, and as you are aware that MACD is actually a derivation of the moving averages, and here you can see the now in the upper pane of my chart you can see the MACD indicator, which is again derived from moving averages, so there is nothing new here. MACD, the red solid line, it is the MACD line, which is nothing but difference of 2 moving averages, right? I am calculating the 9-day exponential moving averages, and I am calculating 26-day exponential moving averages, and I am subtracting the 26-day value from the 9-day value to calculate the MACD, right? So it is pretty simple, and I am also drawing a horizontal line at 0 value, and whenever the MACD, the red line, is crossing the horizontal line, suppose here, suppose in this region, suppose in this region, or suppose in this region. So these are some sort of robust buying signal, as you may say, right? Or you can also take it here. Okay, so these are robust buying signal, right? And you can see in my chart the prices of Nifty from September to this April, which is really 7 or 8 months long, and in this 8 month we got only 4 signals on daily chart from MACD zero line crossover, right? So this is really a robust signals, and these signals are highly reliable, right? But I want to take you a bit further, and I want to give you an even detailed perspective of this. And there you can see the dotted line in the upper pane, that this dotted line is actually the trigger line, right? This dotted line is actually the trigger line, which is nothing but again certain exponential moving average of the MACD line, right? which is the 12-day exponential moving average. And then the purpose of this dotted line is to some extent to smoothen the movement of MACD line. Now here I am going to tell you a relatively unknown indicator, which is a relatively rare indicator, which is called MACD histogram. Now MACD histogram, actually what does it do? MACD histogram, first of all let me plot MACD histogram. Okay. Now, in the middle pane, I have plotted the MACD histogram. MACD histogram is nothing but only the difference between the solid line and the dotted line of the MACD, nothing else, right? The difference is exaggerated here by some multiplication factor, or just we are viewing a magnified version. And you see, whenever the dotted line or whenever the solid line in MACD is going above the dotted line, going above the signal line, we are getting a crossover signal of MACD histogram as well. So MACD histogram as such is not a new indicator. It is also derived from MACD, just like MACD itself is derived from moving averages. So MACD histogram is derived from MACD, and it gives the difference between the MACD line and the dotted line, right? When the MACD line, the solid line, is below the signal line, we get a negative value of the MACD histogram, right? And when the MACD line is above the dotted line or the trigger line, we get a positive value of MACD histogram. Now this is how simply MACD histogram is plotted, and this is the very logic of this indicator. But why I'm telling you this is this indicator is a very strong, potentially very reliable trend indicator, right? But there are two catches. The signals do not come always. The signals come rarely, but when they come, they have high reliability, high order of reliability, number one. And number two, there is a consideration of time frame. Right now, you are seeing the MACD histogram on only daily chart, right? But MACD histogram gives its best signal not on daily chart, but on weekly chart, right? Now, let me turn this picture into a weekly chart, and let me show you what is what, right? Okay. So here we have opened the weekly chart of Nifty along with the weekly chart of MACD histogram and MACD. Right now I'm not talking about MACD, but the MACD histogram. Now MACD histogram gives its strongest buy signal, right? And I'm mentioning here it is the strongest signal in technical analysis by any means, as referred by Dr. Alexander Elder. And what is the signal? When the MACD histogram is below the zero line, right? The red line is the zero line. When the MACD histogram on weekly time frame is below the zero line and it is reducing its value and its slope has just turned upward, right? Look at the point where I have drawn my vertical line, right? The red vertical line. shows the point where MACD histogram was tracing a very low value. It was about 2016 December. On weekly chart I can see that MACD histogram was tracing a very low value, and then it started ascending from there, right? Prices was there at 82.61 on around 9th of December 2016, and the prices really made a very strong movement from there. But initially there was a pullback, and this pullback even made a new low, or did it 79.16 and 78.93. Yeah, briefly a new low was made. So anybody who would have bought it here, maybe he was triggered his stop loss, but actually price went higher from this region. So once you may be stopped out, right, and you will really exit from there. It does not mean that just because there is a MACD histogram buy signal, you will hold your losing trade forever, right? No, that does not make sense. You will have to exit. You will take your loss there. You will take your loss there when prices will have made a new low in spite of the strongest MACD buy signal, MACD histogram buy signal. But again, when prices are going above this region, that is some 80-60 region, and that will give you even strong buy signal. And this is the actual point where you should have bought, or I should have bought, keeping the stop loss here. So this is a very strong buy signal from MACD histogram. Now come to this region, right? Again, we are seeing that MACD histogram has traced a zero value, negative value here, and it is rising here, right? How to define the rising slope? Here, by rising slope I mean this, right? By rising slope I mean this, right? So this was the time when MACD histogram was actually rising. Yeah, prior to that there was another signal here, but prices, but anyway, if you thought prices will go higher from here, then you will have bought it and your stop loss will be triggered below previous week's low, right? And again, you have to take a buy signal here, right? Because prices are again, MACD histogram is again sloping upward, right? So this is another buy signal, strong buy signal. The same thing occurred here again, or here again, when MACD again came below its zero line and started sloping higher. So this is again a buy signal, and as you can see from the chart, prices were in a strong uptrend, and these were very valid buy signal. And to the right of my chart, we can see another valid buy signal from here. MACD histogram is again sloping higher from here. So unless Nifty actually makes or continues in its primary downtrend, in that case the stop loss here will be triggered, and nobody should hold a long position. But if the primary uptrend continues from here, then this will prove to be a strong or valid buy signal, right? Now this is a valid buy signal from MACD histogram, and this happens to be one of the strongest signals in technical analysis, right? In a bear market, right, the reverse will also hold true. Suppose it was in a bear market, and in this region MACD histogram was coming low. That is, it has made a value, it has traced a value higher than zero, greater than zero, it was positive, and then it is sloping lower. But from my experience, I have seen that MACD histogram buy signals are more reliable than MACD histogram sell signals. It is because prices actually show a general uptrend over a long period of time, right? So if prices are really in a primary downtrend, then MACD histogram buy signals will fail. But that much is only to be considered, right? Whether prices are in an uptrend or prices are in a general downtrend. In a primary uptrend, in a primary bullish market, you have to take only the buy signals from MACD histogram. In a primary bear market, it is good. I am not telling it is easy. It is difficult, but it will be good if you can take the MACD histogram sell signals when MACD histogram is above the zero line and starting sloping lower, just like this, or just like this. Okay, and you can see many other examples previously. Suppose this one, another case when prices are, when MACD histogram was below its zero value and it was giving a buy signal, it started showing an upward slope, right? This was another instance, and in this case also prices did not go higher, right, from the next week, but the stop loss was not triggered and your long position should have been held, right? So these are the things, and this is the point where actually change of trend occurred. So here once or twice you will be stopped out. So MACD histogram this way gives you one of the strongest signals in technical analysis, and this MACD histogram is nothing but derived from MACD, which in turn is derived from moving averages. So MACD histogram is nothing but a moving average indicator, and that's why it featured in our today's discussion, because we are talking today about moving averages and its various other ways of using. So you can use moving averages not by plotting the moving averages itself on the chart, but by using the MACD histogram as well. And that, I believe, has a strong advantage, as I told you, as I showed you here, right? Now, okay. Now we are done with MACD histogram. In case if you have any doubt, you will revert to us, and the mail ID of mine I will be giving at the end of the video, and this video will also be uploaded on YouTube. You can give your comments there, and if you can ask your question, I will definitely reply to that. Now let us close this MACD histogram and come to our second topic for today. Okay, second topic is nothing new again. We are going back to the daily chart now, but the combination that I am going to use will be very effective. Although it is very simple, but the combination is going to be very effective, right? Today I am going to show you a combination of MACD and the 200-day moving average to detect the trend of the market, right? Now look at the chart. The red moving average, right, is the 200-day moving average, and the indicator to the upper pane of my chart actually is the MACD. Now I have shown you earlier there are various signals from MACD that is possible. The simple crossover between the MACD line and its signal line that occurs many times is the simplest signal, but this is not reliable at all because these signals are very frequent, right? So I suggest you not to follow the MACD and MACD line crossover signals. Those are not reliable. MACD divergence is also a strong signal, but many a times divergence also fails, especially when prices continue in a longer term uptrend. For example, you can see on my chart that the entire 2007 bull market is shown here, and there are lots of negative divergences in MACD that did not actually work, and prices actually kept going higher and higher, disregarding the negative divergence. So although negative divergence is a strong signal and it is to some extent an advanced indicator, but advanced signal of market reversal, but it fails more times than it succeeds. So MACD or any other divergence, I do not trade. The most important signal from MACD is actually the crossover of the MACD of its zero line, right? As you can see from the diagram above, that the blue horizontal line, which is showing the zero value of the MACD, most of the time has remained above this zero line for the most part of the bull market. Only thrice in August of 2017, in October of 2017, and in December of 2017, actually MACD came below the zero line for a brief period of 2 weeks or 1 week, and again it went swiftly higher. It was only the second week of February 2018 that MACD again came below the zero line, that it stayed there for a significant long period, and very recently, only this week, MACD has again gone above its zero line. So you can see from this diagram that MACD histogram, if stays above the zero line, that is a significant indicator of a long-term buy signal or a long-term bull market. But there are whipsaws here, right? As we saw, there are 3 whipsaws in past 12 months. So our objective will be to overcome these whipsaws, right? And again, I'm going backwards to some extent, and as you can see here, right now in 2016 October, MACD actually again came below the zero line, and it stayed there for a significant long period, and also prices show some strong correction there. And when MACD again went above the zero line in 2007 January, that was the beginning of a new bull market. So here are the challenges. MACD being above or being below the zero line is a significant indicator of trend, right? But there are whipsaws. Is there any way to overcome that weakness? Yes, there is. I'm using 200-day moving average in combination with MACD to eliminate the wrong signals of both the indicator. I'm using this moving average. Why I am using this moving average? Because a 200-day moving average is also a very robust signal, very robust trend indicator, right? And sometimes prices will go above or below a particular moving average. Say, for example, as it did here. Look at this particular period, right? When prices actually crisscrossed, went higher and below the 200-day moving averages for many times, 5 or 6 times. So if someone trades only with the help of one particular indicator or one particular moving average, then he will be stopped out here several times. But now look at this MACD, what it did in the same period. The MACD in the same period actually stayed above its zero line for the entire period. It never came below the zero line, right? So if we use the combination of these two indicators, if we use these two indicators combiningly, then there is a fair chance that these kind of whipsaws, which happen to be the uh, the weakest, which happens to be the most greatest weakness of moving averages, we can eliminate this weakness, and we can create something really robust. And what is a robust trading system? A robust trading system is that something which does not change its signal on a regular basis, right? Which can withstand the pullback against the trend and stays in the direction of the trend. So here I am suggesting you to decide what is the trend of the market from the moving averages, but that is not the only indicator. I am suggesting you to use two indicators. One is the 200-day moving average and the other is the MACD. If prices stay above 200-day moving average, and this is what my trading logic is, or my trend indicator logic is that when prices are above the 200-day moving averages and when MACD is above its zero line, that is the uptrend, right? And this uptrend will remain valid until both the indicators, that is the prices come below the 200-day moving average and MACD crosses below the zero line. Unless this condition happens, the trend remains upward, right? So the conditions are fairly simple. I am telling it again. If both the conditions satisfy, only then it is an uptrend. And if both the conditions satisfy on the opposite side, only then it becomes a downtrend. Now, sometimes it will so happen that one particular condition is nullified and the other remains valid, just as it happened here in 2016 of April, May, and June, that prices stayed above and below the 200-day moving average, and it was a choppy session. So here, my signal will not change. My signal will change where I am showing you here. This was the time when, yeah, I'm taking it here. On this particular day, look, prices for the first time went above the 200-day moving average, right? And by that time, MACD was already above the zero line. So trend actually changes from here. The initial downtrend, the downtrend that we see to the left of this part, actually ends here, and the uptrend starts at this point. Now, in the following 2 weeks or in the following 3 weeks, prices come many a times below these 200-day moving averages, but never the MACD actually came below the zero line, right? That means the trend does not change just because one of the indicators is reversing its signal. I need two indicators. So this system will need both the indicators to reverse its signal. Only then a trend of change of trend will be signaled, right? So this is the primary logic. If both the indicators are above, MACD is above its zero line and prices are above the 200-day moving averages, it is an uptrend, right? Unless this uptrend is valid, unless both the indicators are in the opposite side of their make or break zone. That is, if prices are below the zero line, prices are below the 200-day moving averages, and the MACD as well comes below the zero line, only then the uptrend will be reversed. If any one of the indicators change its signal, the uptrend will not be reversed, right? And you can now go to the right. Suppose this downtrend will be valid for a brief period of time only from this region, right? This downtrend will remain valid. See, this was a pullback, but after the pullback, prices again went higher the 200-day moving averages, then went lower, then again went higher and went lower, and it did this many times. But during this whole entire period, MACD actually never changed its position from the below zero line to the above zero line. So in this entire period of choppiness, as I'm showing you here, in this entire period, right, which is a very difficult period for any trader because we do not know what is the price going to do. In this entire period, MACD never changed its position from negative value to positive value. MACD, when did MACD change its position from negative value to positive value? It is here, right? So prices were below the 200 DMA at this point. So roughly at around here or here, both the signals actually occurred, that the MACD was above its zero line and the prices was above its 200-day moving average. So at this point, I will say the downtrend that started here on the 15th of November is actually ending here on 11th on 11th of January 2017. And here I have every reason to go long, and here I had reasons to go short, right? So this way, this innovative way of using two separate indicators is actually eliminating the weakness of one indicator, and I'm using the strength of both the indicators, right? And the general allegations that are levied against the moving averages, that these give losing trades during a choppy range of market, can actually be overcome by using this particular technique, right? Now I am drawing your attention to these three portions here. That is in around October of 2017, at around December of 2017, and at around August of 2017. So now look at this period. Although MACD actually made a crossover below the zero line, so MACD gave us a wrong signal, but prices never came below the 200-day moving average. So this signal, that previous buy signal or the previous signal of the uptrend, actually never changed its position, right? So the uptrend remained valid, and this is the beauty of this logic, is that previously we saw weakness of the moving average. The 200-day moving average was actually rectified or actually corrected by the MACD. Here MACD made a mistake. MACD gave us wrong signal, and this wrong signal was overcome by the 200-day moving average, by the use of the moving averages. And that is the entire logic of using this particular technique. I know that MACD is again derived from a moving average, and I'm using moving averages. So this particular trading signal, this particular not trading signal, but whatever I'm giving you is a kind of trend analysis. This particular trend analysis signal is entirely dependent on moving average. So this goes against the common sense, against the nature of the common sense, because as you see, it is very common to use moving averages with certain other kind of momentum indicators like RSI, stochastic. They are different from moving averages. But here I am using one moving average and another momentum indicator, which is again derived from moving averages. My logic is that MACD is, although it is derived from the moving averages, but the time frame of the moving averages are entirely different. Here we use 9-day exponential, here we use 26-day exponential, right? And these moving averages are relatively short term, and I'm using a longer term moving averages of 200-day denomination. So I'm using various time frames Although I'm using one particular class of indicators, which is moving averages, but I am using different time frames. So it makes sense that I am basing my signals based on various time frames. So I do not see why we should not be using this kind of trend analysis, which uses moving average and MACD of different length of window, right? Different time frames. I cannot use an MACD and a 30-day moving average for that, because 30-day moving average and an MACD are pretty close as far as their time frames are concerned. So that is the logic. Now here I go one step further. As you remember, in our previous sessions, we had talked extensively about Metastock programming language. So in this case, we will prefer to play a bit with this thing, with whatever we created right now. And right now I'm suggesting that if we follow this particular system, there is no need to actually plot the moving average and the MACD. Rather, we are going to create a new indicator here that will be based on the logic that we taught right now, right? And what is the logic? Right now we are going to create an indicator which will tell us exactly when this condition is satisfying, right? Exactly when the uptrend is occurring, that is exactly when prices are going above the 200-day moving average, as well as MACD is above its zero line, without looking at these indicators separately. Now let us try to do this. Is that possible? Let us try to do this. We are going to create a new indicator. Which I will name as proficient. That is the prefix that we have to give to any indicator. I generally give to understand that this indicator is created by me, to differentiate it from the indicators that is already given there by default in Metastock. And I'm giving it the name as 200 DMA plus MACD, right? The name suggests that I'm going to create a new indicator, which is based on the logic that I told you right now. And the objective is to use this indicator instead of the moving average and the MACD, right? So here we go. I'm going to use the if function, right? As far as I can remember, this particular function I have not explained in my previous videos on Metastock programming language, but don't worry, the syntax is pretty simple, and you will learn it here. And if in case there is any problem, I will cover this function in one of our later videos. So if just follow the syntax, you don't have to follow the programming, because you can copy it in your own Metastock by looking at this video. If closing price is greater than the moving average of 200-day denomination based on closing price and based on simple calculations, if closing price is greater than the 200-day moving average, and I can use an AND function to combine two different logics. And MACD, this is the function of MACD. With whenever we are writing MACD, we have to open and close a bracket to make Metastock understand that we are using the normal by default values of MACD. So if closing price is greater than the 200-day moving average and MACD is greater than 0, right? So this is my condition. This is my primary uptrending condition, right? When closing price is greater than the 200-day moving average and the MACD stays above its 0 line, I will tell my indicator to give me a value of 1. right? So this indicator that we are going to create will give us a value of 1 when we are in an uptrend, right? And when this condition is not satisfied, we also have to define that. What will happen if this condition is not satisfied? That is the third part of the if function. If this happens, that is, this is the syntax. If this happens, then do this, else do this, right? Now we are writing the else part, and we are using a nested if function here. The else part is again an if function, right? Else if. Now here we are giving the condition of the downtrend. Else if closing price is less than the moving average of 200-day denomination, right? And MACD is below the 0, right? Then this is simply the else part. The Metastock will check first whether the uptrending part is satisfying, and if the uptrending part is satisfying, it will just give us the value of 1. And if the uptrending part is not satisfying, then the Metastock will check if the downtrending condition is satisfied, and in case that if the downtrending condition is satisfied, maybe the Metastock will give us a value of -1, right? And if none of this value happens, none of this condition occurs, that is, there is a possibility that none of these conditions will occur, then what will Metastock do? In that condition, in that case, we order or we command Metastock to continue with the previous value, right? Whatever the previous value was there of the indicator, may it be 1 or may it be -1, it will give us that value, right? So that is how the function is created. I am closing both the brackets, and that is how the function is created. And let us check if we have done any mistake there. If I am pressing this, when I will be pressing this OK button, and if Metastock accepts this, then I will understand there is no mistake. Okay, Metastock accepts my program, and there is no mistake. So let's plot this indicator, right? So here you can see the new indicator that we created right now, and right now I'm going to plot this indicator. Here we go. Yeah. So you can see this is the indicator that we created right now in this class. Okay, what did we do? The middle part of this indicator. Now you can see that this indicator is giving us only two values. One is, the first one is +1, and the other one is the -1. So this indicator is either at +1 value or is at -1 value, right? And see now that as long as when this indicator is going from -1 to +1, now look at this area. Yeah, look at this area. This was the time when the indicator actually, as I had showed you this condition earlier, this was the time when the indicator that we created actually went from -1 to +1. What does it indicate? It is on this particular date that the condition of uptrend was satisfied. What was the condition of uptrend? The condition of uptrend was that prices will be above its 200-day moving average. On this particular day, this occurred, right? On this particular day, it occurred that prices on this particular day was above its 200-day moving average. The crossover occurred, and simultaneously the MACD, as you can see it from here, is again above its zero line, right? So this is the condition of an uptrend. This condition actually occurred here on this particular day. So the indicator that we created gives us a signal of an uptrend. But on these particular days, suppose on here, right, or here, on these days, although prices was above its 200-day moving averages, prices were above its 200-day moving averages, but look at MACD. As I told you earlier, this MACD was actually below its zero line. So this was not a buy signal, right? This indicator that we had created, we just created right now, is sensing this, that both the conditions are not met here. So it is not changing its signal from downtrend to an uptrend, and it is staying in the downtrend, and we are getting advantage of it by looking at this. The downtrend actually remains valid for two more weeks, right? So why we did this? We created this in order to not to look at these indicators anymore, right? Now that we have created this particular indicator, we no more need to look at the moving averages and the MACD to actually get the signal, right? Now we can look only at this indicator that we created, and we can get our indication of change, right? So right now I have come to the latest portion of the chart, which is yesterday's price, 13th of April 2018, and this particular signal was there on Thursday, which is the 12th of April. This particular signal was there. The prices went above the 200-day moving average, as well as MACD went above its zero line. So this particular case occurred here, and the reverse sell signal was there, right? It was there on 19th of March. So yeah, it is a bit late, but still we are staying in the primary direction of the trend. The objective was to create a trend indicator which will be robust, which will not change its signal very frequently, and which will be able to withstand the pullbacks of the markets, and which will keep us in the primary direction of the trend for a pretty long time. And I believe that objective we have achieved here by doing this, although you will have to do a lot of backtesting to actually validate the use of this indicator. But creating a backtest will also require you to find out an exit strategy, right? We have not talked anything about the entry or exit strategies here, which we can cover in one of our later videos. So using this indicator. So I hope you have joined this. We have enjoyed this session, and mm, keep liking our videos. Keep asking questions. We'll be very happy to address your problems, address your queries. And so goodbye for today, and let us meet again. See you next week. Thank you.